Cool. Hey guys. Welcome to this webinar on helping you figure out buying your first home. I'm JB. I'm the founder of Squirrel, and we've been going for about 12 years now. We're predominantly in Auckland, but do write mortgages right through the whole country. Most of my experience as a property investor, developer, and buyer of property is in the Auckland market. So forgive me if I keep referring back to that. Yeah, look, we do about $1 billion of mortgages a year. I guess that makes us reasonably big, and we deal with a lot of first-home buyers. The purpose of doing these webinars at the moment is there's a huge amount of first-home buyer inquiry, particularly driven by the removal of LVR restrictions. There may be a sense that house prices could be a little bit more affordable, both due to the low interest rates, but also maybe because of lower house prices. That's creating a lot of work. And at the same time, it's actually getting harder and harder to get stuff approved by the banks. So we thought that these webinars would be a great way of helping you guys get prepared before you're coming in to do a mortgage application. So let's get stuck into it. I've already told you a bit about Squirrel, so we'll leave that there. I'm going to talk about, tonight I'm going to talk about this in two parts. The first part, I'll talk about the housing market. I guess that's really important because one of the big questions is now a good time to buy? What's going to happen with house prices? What's going to happen with interest rates? What does that mean for me? And then the second section, we'll talk about bank credit policy, what the implications are of that, and how you can prepare yourself to buy in this market. So let's get started. I'm kind of sitting on the fence in terms of the housing market. Look, my view is that house prices will fall a little bit in the next year or so. It's a natural part of a recession. And it's really unavoidable in the sense that, unemployment is expected to get to 10%. So you're going to have a supply-demand imbalance. You're going to have people that are keen to sell, and you're not going to have so many buyers. At the moment, it doesn't feel like that. If you're out in the market at the moment, it's quite busy, especially in the first home buyer part of the market. To give you some perspective on it, we've had about a 400% increase in mortgage applications coming through, and that's predominantly being driven by first-home buyers. Some of that will be because the banks are just too hard to deal with now, so people are choosing to come to a broker first. But some of it is a reflection of just how much first-home buyer activity is out there in the market. What I'm going to show you now is a graph, and it'll probably take me 5 or 10 minutes to talk around it. But look, I'm forecasting that the average house price in New Zealand will hit $1 million by 2030. I'm not a big fan of, the old sort of wise tale that house prices double every 10 years. It just so happens that they have doubled every 10 years or even more than that for the last 30 years. There's been a pretty massive increase in house prices, but look, it simply can't continue. House prices will always be a function of income and affordability. The interesting thing, and perhaps what's driven it the most, is just decreasing interest rates. And we've been in a 30-year cycle of decreasing interest rates, and that's largely flowed through to house prices. And of course, interest rates are still falling. So what you see with this graph, I am screen sharing, aren't I? Yeah, good. So what you see with this graph is the orange bars is historic house prices going back to the year 2000. And the grey bars are pretty much what I'm sort of forecasting for the next 10 years. So that's your house prices. The blue line across the page is affordability. So what I've done there is said what proportion of after-tax income is required to service a mortgage at an 80% loan-to-value ratio after tax, and that's on a principal and interest basis on a 30-year term. So the first thing to note is that there's been a pretty massive increase in the average house price. So it's gone from just under 200,000 in the year 2000 up to 670,000 at the end of last year or earlier this year. Massive increase. And as I said earlier, driven in large part due to a change in interest rates. Back in the year 2000, the average 2-year fixed mortgage rate was around 8.5% to 9%. So a hell of a lot higher than rates are today, where, you know, 2-year fixed rate today is about 2.7%. The really interesting thing here is that affordability hasn't changed. And in fact, affordability around 2007, 2008 is a lot worse than it is now. And that, you know, as you would expect, that's because interest rates are so low. So yes, you can take on more debt, but, you know, the proportion of your income that's going towards debt servicing hasn't really changed. And if anything, it's probably been tracking down slightly. So how does this factor into the forecast? There's probably a couple other things that you need to know. So the first is that household incomes in New Zealand have been going up at about 3.5% per year, close to 4% actually per year for the last 10 years. Last 20 years. So on average, household incomes are going up, and that's a good thing. Household incomes have been going up, which means that you've got more income to service debt. Inflation's been very low, so, you know, some of that is actually real increase in household incomes, and interest rates have dropped massively. And between the two of them, that pretty much explains house prices today. If you take that house price in the year 2000 and you simply multiplied it by, say, the underlying growth rate in household incomes, that would take you to a house price today of just under 400,000. And then if you factor in the fact that interest rates have dropped from, let's say, 8.5 to 4, they've actually gotten lower than that, right? But let's just assume they've halved, then that's the rest of the difference. That explains the rest of the difference in prices. So if we look forward, I guess I'm expecting a couple of things to happen. The first is that we are going to have a supply-demand imbalance. Now, the interesting thing is that unemployment is a short-term shock. So nobody is forecasting that New Zealand's got an ongoing unemployment problem. They're saying basically, look, for the next couple of years, maybe up to 2023, we're going to have higher unemployment as there's quite a big shift in our market, particularly around tourism, but also retail and hospitality, and that's going to drive up the unemployment rate. But then they're expecting the unemployment rate to drop and come back down to levels similar to what they were before COVID-19 happened. So it is a temporary shock. And so any price adjustment will be temporary, and then it will go back to fundamentals. And there'll be people out there, in fact, there are people out there that sort of say, housing's overpriced, you know, And I've been saying it for probably hundreds of years. It's always overpriced. The thing is that what you see with that graph is that what's not changing is fundamentally people are prepared to spend about 40% of their after-tax income on servicing debt. And if their income's going up, then the amount that they can service is going up, and that will gradually push up house prices. The second factor, reducing interest rates, well, they can't get much lower, right? But they still can get lower. And the argument that interest rates could go back up again, sure, but they're not going back up to, I guess, 18% like they were in the early 90s, or to 8% as they were in the early 2000s. Those interest rates are kind of gone. We've got a good, stable economy, and it doesn't take much of a shift in interest rates to crush inflation. And what inflation have we got? Where is it? So my forecast basically says, look, next 2 or 3 years, you're going to have a price fall. In that particular graph, I think I've dropped house prices on average by about 7%, which is roughly what I think it will do. And then what you see is that affordability and very low interest rates and ongoing improvements in household income long term start to push prices back up again. And that's how you end up at $1 million in 2030. I'm pretty comfortable with that forecast. Sure, it might be a little bit lower than it, might be a little bit higher than that. But my point is, house prices, I kind of think of it a little bit like KiwiSaver at the moment. If you look through the short-term fluctuations, as far as a long-term asset's concerned, I think it's going to do you pretty well. The other thing that I would say is that a bet against housing is a bet against the Reserve Bank, and it's a bet against the government. You've seen, certainly in the last few months, how responsive our regulators and our government are towards supporting homeowners. And it's not surprising because so much of our wealth is tied up in housing. The Reserve Bank, obviously, alongside the banks, put in a mortgage deferral for 6 months so that people who have been impacted by COVID don't need to pay their mortgage for 6 months. What's happening for renters? If you're renting a property at the moment, you still got to pay the rent, right? And landlords might have been negotiable for about a 4-week period there if you're lucky. But there's nothing there for renters, yet homeowners are constantly looked after, whether it's mortgage deferrals or it's ever decreasing interest rates. I mean, let's face it, mortgage interest rates now 2.7% or lower. It's certainly a lower cost to own now than it is to rent. In so many ways. And in fact, if you allow for the fact that there will be some level of property inflation over the next 10 years, you're almost living for free. So it almost feels like sacrilege to say that. And of course, in Denmark now, there's the world's first negative interest rate mortgage where the bank pays you to borrow money off them. Don't ask me how that works. I don't get it. So look, I'll sum this bit up and then I'll open up the Q&A and we'll have a bit of a chat about this to start with. But look, my view of it is that you're going to see a drop in house prices. The interesting thing here is that I don't think you're going to see a big drop in entry-level prices, so don't get too excited. If I looked at Sydney and Melbourne last year, they had quite a big price reduction in Australia. It was driven by a whole lot of factors over there. But look, there was a short-term, pretty substantial drop in prices, about 15% in Sydney and Melbourne, and it was largely driven by house prices in the top 50% of value, and in particular in the top quarter. So the top quartile, those prices were falling as much as 30%. A lot of it was driven by offshore sellers trying to get out before there were tax changes in Australia, and they were prepared to sell even at reduced prices, and that drove prices down. Entry-level prices in Sydney and Melbourne didn't change that much. And I think you're going to see the same thing here, which is there's a lot of people keen to get into the market. There's a lot of first-time buyers out there. You're all competing for entry-level product. There's not a lot of good entry-level product out there. And so I don't really expect to see that part of the market fall much. It may fall a little bit, and in certain markets it could fall a bit more, Queenstown being an example. But I generally don't expect to see that part of the market fall too much. The exception is probably apartments, and particularly apartments in Auckland. I think you could see some real softness there because it doesn't have the same supply-demand imbalance. Look, at the end of the day, house prices are fundamentally driven by confidence, and they're fundamentally driven by supply and demand. With apartments, you're going to have a lot of supply. A lot of empty apartments because we just don't have the students, international students here, Airbnb vacancy. So generally, I think, apartments will be under a bit more pressure. And there just isn't a demand. Kiwis and first home buyers aren't yet enamored with apartments. They're still, they'll buy townhouses, they'll buy units, but apartments, it's still not really there. And it's not surprising because a lot of the apartments in Auckland are either too expensive or they've been built for property investors and optimized for rent as opposed to optimized to live in. They're not necessarily places that you'd like to live in. There's some wonderful apartments, but some of them, let's face it, they're just built to basically ship people in and out, a bit like cattle. Maybe some of you guys are living in one at the moment. So look, I think that's pretty much how the price is going to play out. As far as interest rates are concerned, I don't know how low they'll go. I'm surprised they've got this low. I really wasn't expecting it. I didn't think that the banks could really afford to go below 3. And I think if they, the fact that they have gone below 3, it's probably reluctant because it's really starting to cause margin pressure and impacting on their profit. and they're not really competing for volume growth at the moment. They're only really trying to stay in market, not grow their share of it. So it's an interesting time. But interest rates could go lower. You know, the Reserve Bank has been flagging to the banks that they need to be prepared for negative interest rates. That doesn't mean it's going to happen, but the fact that the Reserve Bank is talking about it publicly suggests that, you know, interest rates could go lower. The other thing the Reserve Bank's been doing is buying a lot of government debt and pushing down long-term interest rates. And you're seeing that because you've now got 3, 4, and 5-year fixed housing rates below 3%. All of that quantitative easing and signalling that's coming from the Reserve Bank is suggesting that rates could go a bit lower, and rates will certainly stay low for a long time. So that's a bit of a feel for the market. So look, what I'll say, I'll pull out of this presentation now. You'll see Q&A at the bottom of the screen, and you can type questions into that. I'll go through them and sort of try and answer as much as I can. We'll stick at this stage to maybe just talking about house prices and interest rates and sort of those macro factors. There'll be a chance for us to talk about bank credit policy shortly. So let's just jump into that. And have I stopped sharing my screen? I have. So, okay, so there's a Q&A at the bottom. So if you guys just start peppering questions into that. Alternatively, there's also a chat function, and you can put it into chat on the side. And I'll give it the best that I can. So, hey, so first question from Emily. Is there a benefit to purchasing this year or holding off until next year if prices are predicted to fall? That's a really good question. So, look, my view on this is that twofold, really. Good properties are hard to find. So it's going to take a while. You kiss a lot of frogs before you find your prince, right? And it's going to take you a while to kind of figure out exactly what's good value in the market. The second thing that I would say is that house prices don't fall slowly. So one of the misconceptions that you're going to get is because if you follow the media too much, the media is generally 2 or 3 months behind the truth. Because they're not going to be reporting a reduction in house prices in New Zealand for probably at least another 1 to 2 months yet, because that's how long it will take for it to come through in the statistics. You know, they're going to have to wait for these properties to settle before it comes through in the numbers. So, look, I'm kind of expecting to probably not start to see a reduction until maybe July, in terms of getting it reported, July at the earliest. And then it's going to be very gradual. It'll be like, oh, house prices year on year are down 0.5%, another 0.5%, another 0.5%. And in about a year and a year's time, we'll be like, oh, house prices are down 7% year on year. And it will feel like, oh, it's just suddenly happened, but it's been gradually happening all year. Look, my view is that if there's a buyer out there and they need to sell now. They need to sell next month. They need to sell the month after. House prices actually can fall quite fast. There's probably vendors out there now that are quite happy with a 10% reduction in house price just to get rid of it. They're there now. There might be more of them in a year's time. But, you know, the reality is that there are vendors out there at the moment that want to sell and want to sell quickly. So I kind of think my view on this is don't rush into the market thinking you have to buy really quickly. But I think it's good to be in the market now. You know, increase your chances of finding the right property. The other side of it, I'd say, is you've got to... First home buyers tend to rush in and out of the market together, and there's a lot of you. And for those of you that maybe have been dabbling in the market for a while, you know what I mean. It's confidence driven. And what tends to happen, and we've seen this a lot in the last 7 or 8 years, is first home buyers all sit on the fence, and then they all talk to each other and decide now's a good time to buy, and they all rush in at the same time. And then they all panic and get out of the market again because there's a bad news story in the Herald. And then they all come back into the market, and they all go out of the market. I think one of the good things to do is just be in the market. And ideally, not when everyone else is rushing into the market. You know, the idea of waiting a year kind of says, hey, let me wait until everyone else is rushing back into the market, because then I know it's safe. And I think that very quickly ends up in a market where you find yourself competing at auctions, multi-offers, and that sort of stuff. I'd say be in the market now, but be patient and get to know the market, get to know what you think good value looks like, and be prepared to buy. And I think my point would be that if you find the right property, don't get too concerned about the price. I mean, it would be nice to know that you've bought well, but just think of it as a long-term investment. Lucas, with current interest rates, first home buyer might be able to get mortgage even lower than rent. Yeah, absolutely. Would that be enough reason to jump in the market now as opposed to wait for next year? Probably look same as with Emily. I think my view on this is be patient, but definitely be looking in this market. You know, and as I said to you guys, look, entry level prices won't change that much, and it depends what you're trying to buy. But you know, if you said to me that you want to buy a cute little sort of 2-bedroom bungalow in an emerging suburb that's quite popular, I mean, you know that no matter what happens to this market, that price isn't changing. You know, there's always going to be a supply-demand imbalance in favour of vendors in tightly held parts of the market. You know, if you want to buy something cheap, you're going to buy something that needs work done to it. It's going to be a little bit ugly. It's going to be maybe a deceased estate or an elderly person going into a home who needs to sell. They need to sell in this market. The property's dated. It's not getting marketed very well. You know, historically, you would have been competing with property traders for that sort of property. But whereas now, I think you get a free shot at that, and maybe you'd get that at a good price. But you know, anything that's kind of really attractive and cute is still going to have a lot of competition. I think in terms of new builds, there's some opportunity there. There's a lot of new development stock coming into market. I don't know whether you'll see much of a price shift in that. It's already pretty competitively priced. And I think some of the new development stock's really, really good value for money. You know, the developers have really cut their margins to get a product into market at entry level. That's an interesting space, and I would certainly be looking at that. Sam, do you recommend waiting until you've got a 20% deposit, or 5 or 10% is okay? I'll cover that off a lot more in the next section when we are talking about credit policy. I think, look, 5% deposit is no longer realistic unless you fit the criteria for Kaianga Ora's first home scheme, which in Auckland means you're purchasing a new build below 650,000 or an existing property under 600,000. And then there's different thresholds around the rest of the country. If you're buying inside that scheme, you can still go to 95%. If you're not buying, so if you're purchasing something over 650 or your income's too high and you can't buy in that scheme, there isn't really any 95% lending in the market at the moment. It's all pulled back. 90% is pretty much the max now for a first home buyer. At 90%, you're going to have clean credit. I'll talk about that shortly. You're going to pay low equity fees. You're going to pay higher interest rates. The question becomes, should I wait and save more deposit, or should I get into the market? Look, I think that's really over to you. I think you make a lot more money when you buy than worrying too much about a small differential in interest rate or a low equity fee, provided you're buying well. I think, it just sort of resonates with me to be cautious, take your time, but be in a position where you can strike if you find the property that you really want. And then the amount of deposit doesn't really matter, provided you've got at least 10%. And I think and provided, I think I'd certainly talk to an advisor earlier just to make sure that you're ticking off all the other boxes that you need to tick off. And let's talk about that soon. Sally, what part of the market do you expect to fall in regards to house values, and what pricing bracket is considered entry level? Okay, so bear with me. I think entry level differs significantly across the country. So it's hard to give you one number for every part of the market. In Auckland, entry level to me is 600 to 700,000, and maybe up to about 800,000 in sort of suburbs where you're sort of trying to buy a standalone house, and maybe in Auckland City. Down in Manukau, it'd be a lower price. Certainly outside of Auckland, entry level house prices are much lower. I just helped some first home buyers in Palmerston North, and Palmerston North's gone up a lot in the last couple of years. It's been going up about 15% per year. Entry level in Palmy now for a house seem to be quite close to 500,000. So prices have been moving a lot. In terms of price falls, as I said, look, I'm not expecting huge price falls, predominantly because interest rates are so low. Which means that affordability is not a major issue, and the banks are giving 6-month mortgage deferrals. A lot of the unemployment in New Zealand is going to come into, it's going to be roles where people aren't homeowners. And it's not, there will be people who are homeowners that will lose their job. But a lot of people will be in lower income jobs in hospitality, tourism, and retail. Won't necessarily be homeowners, but they'll be renters. So I think the rental market will come under a bit of pressure. There'll be landlords that might get themselves into a bit of trouble, particularly if they've overextended themselves. So that's something I'm keeping a bit of an eye on. I think you'll certainly see I think a decent reduction in land prices for anyone that's looking to build. And that will be driven because a lot of land developers can't afford to hold sections for a long period of time. They need to move product. Same with builders and developers. They can't build a whole lot of stuff and then hope people will buy it. They need to keep it moving. So it makes them more negotiable. Entry-level houses and new developments, I don't think will move much, simply because they're easy to buy, they're easy to finance. And there's a lot of first-home buyers out there. Land's a different story. Building is tricky and complicated. I think back to the GFC, and we saw section prices falling as much as 30 or 40%, only for a short period of time. And you had to be good at spotting them because not everything dropped. I said earlier, I think apartments could get hit. And I think particularly apartments less than 50 square metres. As first home buyers, one of the things to be careful of, or just be aware of, is that if you're wanting to buy an apartment less than 50 square metres, they're actually a lot harder to finance. And that's part of the reason why I expect to see a bigger price drop in that part of the market. Less supply, less demand. More supply, less demand. Typically, the biggest buyers of those have been property investors. And I think the thing you'll find with property investors, more so than owner-occupied, is that they will wait, and particularly in things like the apartment market and stuff, they will wait because that they will be waiting for a price reduction in that part of the market. Ella's asking, what are your thoughts on leasehold versus freehold for resale? So Ella, is that leasehold or cross lease? Because those are quite different things. So cross lease is where you have a share of a freehold piece of land. And that was common in the 1970s and 80s. It was far easier than splitting the titles. So a lot of builders and developers just used to put a cross lease over a freehold title. And that's effectively not much different to freehold. The restriction is you have to have a flat plan on it. which is a document that prescribes how you build on the land, because of course you're cross-leasing it with each other. It's a bit of a pain in the bum. We see a lot of cross-leases that are out of date, and then you have to spend money with lawyers updating them. It does mean that your neighbour on the cross-lease has some say over what you build on your property. And so cross-leases tend to be valued lower than freehold. They do tend to attract a lower value, simply because there's more restrictions on what you can do, and there's a slightly higher cost keeping those titles up to date. So that sort of covers off freehold versus cross-lease. Leasehold is different again, right? And leasehold is quite dangerous in New Zealand, so you need to be careful with it. If you're looking at leasehold property, I think you should be getting advice. And you do need to look at it carefully. Back in 2008, 2009, a lot of people got caught out on leasehold in Auckland, where the value of their properties more than halved in the space of a year to a year and a half. The big challenge with a leasehold is, of course, that the ground rents can change a lot, and the ground rents are very expensive. So, particularly in Auckland City. And that's the thing you've got to be careful of. Effectively, all you're doing is owning the building. You don't really have any interest in the land, other than use of, and of course that reprices every now and again. The one thing to point out is that there has been recently the development of new kind of leasehold where they try and make it look more like a freehold title. A lot of the stuff that's happening on the Auckland waterfront now has this leasehold where effectively the developers paid the lease up for 100 years, so that you don't have this risk of big leasehold price adjustments. But again, look, it's certainly, once you get to leasehold, it's something that you definitely need to be working through with your lawyer. But I would also suggest a competent mortgage broker. And I wouldn't leave that with the bank, because bank staff just won't understand leasehold at all. Savannah, would you say that there won't be a large price fall in turnkey properties? Yeah. I think turnkeys, so for those of you that don't know, turnkey is where you pay a deposit and you don't have to pay the rest until settlement. So it's effectively just like buying a house and you're just paying a deposit up front while they build it, as opposed to construction lending where you're having to make progress payments, you settle the land, and you gradually fund the build on the way through. So turnkeys are much easier to finance, and they work really well for first-home buyers. Construction loans, we just can't do them with low deposits these days. I think that the best we're seeing in the market at the moment would be 85% construction loan, so needing a 15% deposit, and that's for a full fixed price build with a reputable group builder. So just to give you a bit of a feel for it, but turnkeys are very, very easy for us to work with. Oh, cool, Ella, it was cross-lease, yeah, so I've answered that for you. Look, I think cross-lease properties will go up and fall very consistent with freehold, but there's just a little bit of a price differential. And it's normally, it might be about sort of between sort of 2 and 5%. I mean, it's not insignificant. And the number of people do take the opportunity to convert their cross-lease titles into freehold titles, and they get a bit of an uplift from doing that, but it's also an expensive exercise. Let's see if there's any other questions here. How accurate do you think rateable values are in determining how much to pay for a house? I think rateable values are a bit dangerous, but what you do get is if you're in the market and you're keeping an eye on things, you'll start to see what houses are selling for. And then in that particular part of the market, you can then start to use rating valuations as a bit of a proxy. But what I would recommend doing is on the New Zealand Herald site, under One Roof, there's a valuation tool there with all of New Zealand's properties in it. It's run by a company called Velocity. That's probably your most accurate free assessment of property values. So I would use that. But you know, nothing works better than being in market, particularly if house prices are falling a little bit. The real insight will come from just keeping track of properties in the areas that you're looking at. You know, going to a few auctions, following up with agents after something's sold to see what it sold for, that sort of thing. Yeah, look, price reductions. So there's one question there about price reduction. So look, my view on this is, and I've bought and sold quite a large number of properties, is every house has a price, and if you don't put offers in, you'll never buy. So, you know, as a rule, I put in offers, or I used to put in offers pretty much on anything I was interested in. Didn't mean I got it, but I at least put an offer in. If you're not viewing properties and you're not putting offers in, then you're not really in the market. I also think that when you buy, you're potentially making more money than you make on a PAYE job for quite a while. You know, 10, if you can get something 5 to 10% below value, then I think you're doing really well. But you know, how do you pick a 10% price reduction? Look, I don't know that you do, and I don't know that you should always be aiming for a 10% price reduction. I think you've got to assess the property. You've got to assess, you know, whether it's going to be a popular property or not be a popular property. How urgent is the sale for the vendor? You know, how keen are they to get it sold? And you know, and how much negotiation is there? But there's no harm in at least expressing an offer to the agent and seeing where you end up. In terms of, you know, what does a good price look like? Yeah, look, I think one roof, getting a market proxy for the value of the property, and I think it gives you a heat map, it gives you a range, and I think if you're at the bottom end of that range, you're in good territory, and then you just really need to gauge it. But I keep coming back to if it's a nice property and it's well presented, and you've got, you know, multiple people going through the open home, and there's not a huge amount of urgency there, you're just not going to get a big price reduction. But equally, don't be worried about that. And look, I'll put some context on it. I'm in the process of purchasing a commercial property, and I guess you know, and I did that. I entered into that contract pre-COVID-19. And, you know, I'm sitting there and I'll be settling it in about a year's time. I'm sitting there thinking, shit, you know, I've purchased a commercial property at the top of the market, and commercial properties could drop 20 to 30%. So, you know, because commercial property will drop a reasonable chunk. And I'm sitting there going, oh God, that's painful, you know, should I try and get out of the transaction? And the reality is that it's a really good property. It took me 2 or 3 years to find it. It wasn't even on the market. I actually had to approach the vendor via an agent to buy it. He wasn't in the market to sell it, so I was always going to have to pay a high price for it. Fundamentally, it's a good property, and a developer reminded me that, you know, those properties are never on the market. You're always going to pay a high price for it. And just know that in 10 years' time, it's going to be worth more than you paid for it. And I guess that's the philosophy that I take into property, is that, you know, sometimes the good properties, you're going to pay for them no matter what's going on in the market. Whereas if it's, you know, if I were you guys at the moment and I was targeting property, my favorite search term in trading, and the problem is you're all going to do it and then you'll be competing with each other, but my favorite search term in Trade Me was first time in. So when you're searching property, you get a text field there, and I always found it really hard to find great properties. And then I'd be with a client, the client would come in and say, "Oh, I found this property." I'm like, "How the hell did you find that?" Because, you know, I've been searching the market. I'm just not seeing properties like that. And I think those text boxes are really good. And so first time in, what you're doing is you're guessing how the real estate agent's talking about the property. And the ones that I want are the first time on the market in 60 years, first time on the market in 40 years. Because what I was really aiming for is people going into retirement villages. They generally have really well-maintained properties with really good bones because they're from the 60s and 70s, and they're well kept, but they're dated, and they don't have high price expectations. They're quite happy to meet the market, and to me, that's just such a prime market to be looking in at the moment. So there you go. Oh, have we got any more? Lots of questions. No, we're all done there. Okay, so look, what we might do is I'll jump back into the presentation. So just give me a sec and I'll get this going again. Share screen. Okay. Right. Hopefully that is visible again. So yeah, so look, let's go into part two of the dilemma. Okay, so with interest rates this low, you know, more people want to buy their first home, like you guys, but it's getting harder to borrow. COVID-19 really has made it a lot more difficult, and it's getting access to credit is just getting a lot harder. So it's a bit of a dilemma. Love to buy, it's getting harder to buy, even though interest rates are really low. So look, let's start by just talking about low deposit mortgages. So a low deposit mortgage for me is anything with less than a 20% deposit. Low deposits, mortgages are definitely getting harder. Some banks are requiring full residency. So look, here's the first point. If you are new to New Zealand and you have a residency visa, ideally it has no travel conditions. It's getting very hard now to get people approved where there's still travel conditions on their visa. Most banks are not allowing border income in for servicing calculations. So servicing calculation is the calculation that we have to do for the banks to demonstrate that you can afford the loan. And so we include your income, your expenses. We have to include the mortgage that we're asking for in terms of its limit, and we have to apply a 7% interest rate to that. Not the 2.7 that you'll be paying in market at the moment, but a 7% interest rate, which means that the mortgage repayments are really high. And what the bank's looking for is the fact that you can service a much higher level of repayment, just in case interest rates go up. Now, my key point here is that banks won't allow border income when you've got a low deposit. They prefer to see if you can afford it without the border, and then we can use the border as a mitigant. But we can't use it to demonstrate servicing, which means that you've pretty much got to be able to do it on your own income. There are a few exceptions to that. It's not a cold and hard rule. We did have an example in the last week or so where we managed to include border income on an application that had less than 20% deposit and also rental income because it was a home and income property. Must have a genuine 5% saved deposit, including KiwiSaver. Pretty much non-negotiable unless you're in a kāinga or a scheme, in which case you need a 5% deposit, but they don't really care where it comes from. Minimal consumer finance debt. We're seeing a lot of applications at the moment with debt. I think a number of you probably weren't expecting to buy anytime soon, and maybe have purchased cars, or just being focused on travel. But you know, the consumer finance debt is quite a big issue at the moment, and particularly credit card debt. As I said earlier, we're having to demonstrate servicing an interest rate of 7%. The last point, account conduct and savings are important. This is really important. It's actually quite surprising to me at the moment how hard some applications are to get through the banks because of very minor indiscretions with your banking. It's just not the same market it was pre-COVID. one of my team had an application declined yesterday from a bank because their GEM visa was slightly over its limit. And look, that was just because they'd forgotten to pay it last month. But it was enough for the bank to decline it. They really are looking at account conduct. So one of the most important things for you to do is make sure you've got your banking set up well. You know, don't leave it to chance. Don't forget to transfer money to an account and have a transaction bounce or reverse. It's just not worth it at the moment. The banks are looking very closely at account conduct. They're looking for good behavior. What they want to see is regular savings. They want to see demonstrated affordability. They want to be able to look at your bank account and say, can these guys genuinely afford the amount of money that they're asking for? And can they demonstrate that? And account conduct is one of the first things where they say, shit, these people can't even afford their current lifestyle, let alone having a mortgage. So you just got to keep that stuff real tidy. I'm going to give you an example now. I really probably should rework this, but it's all right. I'm going to give you an example. Tony and Pippa, real original. Combined income, so they earn, I think, $120,000 a year. So that's their after-tax monthly income. They've got all their living expenses there, and if you're looking through that, nothing unusual. Tony does have a small car loan. They do have some credit card limits. I think it's about 10 grand. Tony's got a student loan, and they've got childcare costs because they've got one child. Look, that's probably what average Kiwi household looks like. The average household income in Auckland is circa 130,000. So yeah, just look, that's pretty much what the standard first home buyer would look like. Now, what's interesting is that, and let me go back a slide for a second. So they've got a surplus of $2,900 a month. So that's their income, less their expenses. I haven't allowed for rent in there. If we sort of said rent was $600 a week, that's about $2,700 a month. You know, so they don't have a lot of discretionary income left over at the end of the day. By the time you back out rent and all of the living expenses, there wasn't a lot of discretionary income anyway. So let's assume that their full deposit has come from KiwiSaver and very little in the way of savings. And that's fine. Let's assume that they've got maybe $40,000 to $50,000 of KiwiSaver. So if you went and put that 2,900 surplus, or said that's how much we're paying on rent, how much can we borrow, and you put it in an interest rate of 3%, it would say, nah, you can afford 690,000, and you'd be like, sweet, with my 40,000 KiwiSaver, we're in the market, $730,000 purchase. But that's you putting the numbers into a calculator. When we put it into the bank's calculators, and these aren't the ones that they put on their website because those ones are generally pretty shit. But if we to be fair, on our website, it's not a hell of a lot better. But if we put it into the servicing calculators that we use on our systems, and we apply a 7% interest rate, then the amount that you can borrow is only $437,000. So, you know, it's a big difference. Add your $40,000 to that, you're going to have to find a house for $480,000. Now, outside of Auckland and some parts of New Zealand, that's completely possible. But, you know, good luck in Auckland finding something that you can buy for about $480,000, right? So you'll probably be in Huntly. But look, here's the interesting thing. If Tony paid off his student loan, it would add $88,000 to their borrowing power. If they cleared the consumer finance debt, so this is both that small car loan and the credit card, there would be another $80,000 of borrowing power, and up to $605,000. Now, it's still a bit touch and go in terms of getting into the Auckland market. You're only up to $645,000, maybe $650,000. But my point is, look at the magnitude of the shift from paying debt off. And what we're not talking about is that debt itself is bad, although some debt is bad and some not so bad. what we're talking about is the impact it has on the servicing calculations that determine how much you can borrow. And if we see one major problem beyond people having less than 10% deposit, the next biggest problem is people can't borrow the amount that they need or want to get into the market. And if that number's getting dragged down, it's getting dragged down by student loans, it's getting dragged down by consumer finance debt, and sometimes other costs, but they're unavoidable and they're just cost of living, things like childcare costs, etc. So I really just wanted to emphasize that point. So look, from there, let's open up the questions to talk about bank credit, and we'll see how we go there, eh? So let me close the presentation, and screen sharing has stopped. Cool. Okay. So, I see in chat. I'll answer that one while I'm waiting for a few other questions to pop in. Not sure, are they in order? Yeah, they are. Okay. Okay, so a couple question from Anna. Is it a good idea to buy off plan for a first home buyer? What are the pros and cons? I would be very, very careful buying off plan at the moment in a falling market. Sorry, I should look up here. I think off plan can work incredibly well when prices are going up. I think it can be very dangerous when prices are falling. It depends, but it does depend. Look, in Auckland, I think there's some really good developments where people are buying off plan, and that, as long as you're buying entry level prices and you're buying a product, maybe like a townhouse or a low level apartment, the risks are a lot lower. But it's certainly something to get advice on it and to be a little bit careful about. I think getting legal advice when buying off plan is really important, because you need to be mindful of things like sunset dates. You know, what happens if the developer stalls halfway through the project? With buying off plan, your deposit's safe, it's held in trust in a solicitor's account, so there's no risk to you of losing money. I think the risk that you need to manage is that prices fall, and you don't find that you've got sufficient deposit to settle the property. So it can be well managed. I just think it's one of those ones where you definitely need to be talking to an advisor. Who pays for a meth test, seller or buyer? Ella, the buyer pays for it. Well, they don't have to. A vendor could decide to get a meth test done and give that to prospective buyers when viewing the property. But if it's part of your due diligence, then you're paying for it. I'd be very careful with building reports paid for by vendors. The other thing, while we're talking about that, I'd be very careful with monolithically clad houses. As first home buyers, I don't think buying monolithically clad houses is a good idea unless you're a builder or an architect and you actually know what you're doing. Rose, what is the difference between turnkey and off-plan and land and house package? Okay, so turnkey and off-plan are the same thing. They're just two different names of the same thing. Basically, pay a deposit up front, pay the rest when it's finished. So turnkey being the idea, you don't have to pay for it until you can turn the key. Off-plan is exactly the same thing. Land and house package is a construction loan. What you will see happen there is that a land developer will partner up with a builder. So what will happen is they will sell you the land and they'll say, and you build with this build company and you'll design it, you'll pay a little deposit, but with a house and land package, you are settling on the land, and then we're having to fund the construction through a construction loan. So you're paying interest on that loan on the way through until it's completed, but you own the land from the start of that project. So that's a house and land package. That's no different to you just going and buying a piece of land, going and seeing an architect, getting a house design, and then a builder, and getting them to build on top of it. they call it house and land because they're generally packaging it together, but it's still a builder and you're still buying land off the developer. Any questions on credit? Like what? Oh, here, there's 6 questions. Cool. If you have a bit of savings, is it better to use these savings to pay off debt or just chip away at debt and keep saving for deposit? Brilliant question. And this is a question I've had a lot. So this is probably one of the most important questions. So let's work through it. The most important thing is that you get to 10% deposit, because we really can't do a lot if you've got less than 10% deposit. So that's your starting point, right? You've got to get to 10% deposit. So to the extent that you need to save that, save it, because that's, you don't get past go unless you get to that 10% deposit. Now, for a lot of you, that's going to be coming through your KiwiSaver. So you keep working on that. If you want to speed the process up a bit, by all means, start putting some money aside for savings to get to that 10% deposit. Once you've got to 10% deposit, you're not really going to get a big benefit in terms of interest rates or deals, right? Until you're getting down closer to 80%. In terms of pricing, pretty much everything between 80 and 90 is kind of treated the same way. You don't get a big benefit because you've got an extra 5 or 6K savings, right? So once you've got over your 10% deposit, unless you think you can get to 80% or under 85%, then I would start clearing debt. I really would. I'd just start clearing debt and get rid of as much of it as you can. Student loans are interesting. I mean, they're interest free. So, you don't really want to pay them back, and it's not bad debt. So banks don't look at you and go, oh my God, you've got a $50,000 student loan. How irresponsible are you? They don't do that. They don't even think like that. They largely ignore the student loan. It's not the loan itself that's the problem. It's the impact it has on your servicing, because student loan repayments are like 10% of your gross income per year paid out of your net income. It's a big number. If you haven't looked at how much is coming out of your paycheck each fortnight or month, go have a look. It's staggering. And it's that deduction that has a really big impact on how much you can borrow. Now, if you've got a $50,000 student loan, there's absolutely no point, right? But and I wouldn't deal with this up front. I think this is one of the things that we do as an advisor when we're sitting down with you and strategizing about buying, right? You don't pay your student loan off up front. But what we might do is, if we're sitting down with you, you've got a bit of extra deposit and your student loan's quite small, we might say, hey, why don't we actually just reduce your deposit, pay that student loan off, because it's going to increase your borrowing power by $100,000. And we do that. So I've had a number of clients that have only had small student loans, less than $8,000, where we've paid them off to increase their servicing. In fact, I had one client where she actually paid it off with her credit card, which makes no sense, right? You've just swapped interest-free debt for debt that's about 14% interest rate. But she was only about 4 or 5 months away from paying it off, but it made a huge difference. And she actually had a house under contract at the time. So I was like, I have to settle this. We're like, we can't get that much money. Pay your student loan off. She did. We got an approval. She purchased the house. Okay, Rose, I answered that one. If you're looking at getting flatmates to help with the mortgage, what's the best way to approach it? Boarders versus tenants, or other options available? Boarders is fine, tenants is fine. You can do it either way. Some people do sort of a rent by the room and put a tenancy type agreement in place for that. But you can equally just do it as boarders. I think the benefit of just treating it as boarders is, from a tax perspective, you're probably in much safer territory than if you start to make your property look like a rental property. So I think all we require, if we're using boarder income with the bank, all we require is a letter or some sort of evidence confirming that there will be boarder income in place. As I said, for low deposit stuff, the banks aren't really using it these days. So it's not really adding a lot of value to the mortgage application. But, I mean, border income makes such a big difference to so many of the buyers I see out there in terms of affordability. Even if the banks ignore it, it's obviously still valuable, right? Okay, let's see what we've got over here. If you've been in okay, here's a cool question from OPT. If you have been in a job for less than a year, how much impact can that have? Recently moved jobs, quite big at the moment. Look, so a few things that are happening. So if you've had a salary reduction, i.e. your income is currently impacted by COVID, there's a large number of us out there that are on 80% salary, kind of this work 80%, get 80% of your salary business. Where that is you, we're being asked by the banks to confirm when you'll be back to 100% salary, and they're even asking for letters from employers. If the company that you work for claimed the wage subsidy, that seems to set off some red flags. If you're working in an occupation that's considered high risk, in tourism, retail, hospitality, it's really challenging at the moment. The banks really drill into it, and it's proving difficult to get approvals, even with decent sized deposits for people that banks are concerned will be impacted by this recession. So just to be aware of that. Look, equally, I haven't run into as many issues with people working in their jobs for less than a year. Certainly if you've been in your job for less than 3 to 6 months, really tough. Less than a year, not so much. It does factor into it, but only as one small factor amongst a whole range of factors. If you've been in your job less than a year, you haven't got good account conduct, your affordability doesn't look great, and you haven't really saved a hell of a lot, you're just relying on your KiwiSaver, then, that amongst some of the other factors is probably enough to turn it into a decline. Whereas if all those other things look good, then I don't think they're going to be too worried about it. It will be a bit occupation dependent. If you were in your job less than a year and you were working in a hotel in Queenstown, forget it. Savannah, because of recent travel, I save for and spend in recent car purchase. I haven't been saving a lot of income in the last 6 months. However, I've paid off my student loan. That's awesome. And have no other debt. Perfect. Okay, so how many months is good account conduct? 3. Now, this is interesting because, of course, your current bank can see your entire history all the way back to when you're in nappies. And that can be a bit of a problem sometimes. But if we take you to a new bank, they only need to see your last 3 months worth of history. So, as long as you've got good account conduct, or we tidy it up over a short period of time, you're going to be fine. Look, normally your mortgage advisor is going through your statement data before they submit, and if they're picking things up, they can have that conversation with you at the time. But 3 months of good account conduct's enough. As far as, if you're debt free and you've paid off all your debts, that's fantastic. What's really good sometimes is if we can evidence that, because if we can evidence that you've been paying debt off and quite quickly, that's actually a real positive. And that looks really good. I've had applications approved where they've had quite high levels of consumer finance debt because of things like marriage separations. But we've been able to demonstrate that they've had really good behaviour paying it off, and that's worked well. Lauren, given the current situation, would you say the banks are looking at how long you've been at your current job? Yes, they are. If we wanted to move to a different city, would it work against us? Situational. Depends what it is. If you're moving jobs, if you're moving with your employer, it's not an issue. If you are moving to a new job, then it might be, and it will depend on what sort of work you're in. If you are in maybe an essential service or in occupations where there's a very low risk of unemployment, then I'd say it won't really impact at all. But if you are in occupations where there is heightened risk of unemployment, then I think banks are going to be a bit reluctant to approve you when you don't really have that job history in that location. But that's straight away. Obviously, once you're there working, once you're through a probationary period, I think you revert back to normal. I've had cut of my income due to COVID. Will this stop banks from lending to me? If so, how long after my wage has returned to normal will banks lend to me? Look, it's situational. I had a client today that I've got approved who was on 80% and only went back to 100% 2 weeks ago. So I just provided the bank with their first pay slip back at 100%, and that was approved. So I don't think you have to be back at 100% for a while. They just need to know you're back at 100%. And to be honest, you could get it approved even if you were at 80%, provided it services. We can't say, oh, they'll be back at 100% and therefore it's okay. If it services on your income at 80%, we can still get that approved. The only thing that we would require in that situation is a letter from your employer to confirm that you are going to go back to 100% and that your job's secure. And provide, some employers won't do that, but if your employer is prepared to do that, then I see no reason why we couldn't get that through. Gosh, you guys are firing the questions through. Shit. Over the last few years, I've been paying more than 3% into KiwiSaver in anticipation of buying a home, which is awesome, yeah? Because the rates of return have been better than the bank savings accounts, absolutely. Yes. So KiwiSaver is good account conduct, especially if you've been putting extra in. They love it. It's that's always a good thing. Look, with your KiwiSaver, the thing to be a bit careful of is we had a number of buyers a few months ago that got caught out when the market basically shat itself and dropped about 25%. The market's gone back up again, so everyone's feeling good again about the KiwiSaver balance. But it does highlight the volatility, and there is certainly risk out there that you could see another sharp fall in the share market. So one of the things to think about, given how important this deposit is to you guys, it could be the difference between an 8 or 10% deposit, is to start to take your KiwiSavers into conservative, especially if you're confident that you're going to be buying in the next year or so. The last thing you want to do is be pulling your KiwiSaver when the market's dropped 20%. So, do think about moving your KiwiSaver to conservative because you've got quite a short-term horizon in terms of when you need the money. And especially given it's gone back up, now would be the time to do it. For a first-time buyer with good deposit, 120K, that is a fantastic deposit. Would you recommend still targeting low entry prices or push higher? Really, really good question, Lucas. If this goes back a few years, but look, if you're going to lose money on properties because you're going to buy and sell in a shit market, if you buy a property now and sell again in the next 2 to 3 years, you won't make any money on it. You probably lose money because of all the transaction costs and everything else. Where I've seen first home buyers that are too conservative, they buy something, they get used to owning property, they get more confident, and then they want their next one because it's not really what they wanted. And then you're buying and selling. Now, if the market was going up, not a problem. Given that the next 3 to 4 years is going to be down and flat, that's not such a good position to be in. So my view on this is to push yourself a bit harder, especially if it means that you're going to get a property that you're going to be happy with for a longer period of time. If you can get a property that you're going to be quite comfortable in for at least 5 to 6 years, that's going to see you through all of the shit. You're going to get some good price appreciation off the back of that. And I think that will work out a lot better for you than getting too conservative and just buying something that is not going to keep you happy. So that's my view on it. But everyone has their own personal preference on it. With 20%, can the bank offer you the current loan rate, like the 2.7s? Yes, they can. So with 20% deposit, you're going to get the best rates in market. That's going to give you sort of interest rates between 2.6 and 2.7 at the moment. Look, this is probably a good point to talk about parental guarantees. So you guys are by and large all too old, and I hate calling you kids. And parents and stuff, because it's kind of weird, right? The reality is that for the vast majority of you, you can buy on your own. You do not need, you do not need your parents, right? But why might you use your parents is to get to that 20% deposit. So we call it a limited guarantee. So you've saved 10% deposit yourself. You're not going to get to 20. It's too big a leap. If your parents own property and they're still working, so we can use them as a guarantor, what we do is we do 80% of the mortgage just in your name, secured over your property. The 10% that you don't have of the deposit, we do in your name. You're still the borrowers, but we go and secure it on your parents' property. Now, from a bank perspective, that makes you an 80% loan, even though you've borrowed technically 90, 10% of it's over the parents' house. That makes you an 80% loan. It's going to get you a much better deal. So to put that in context, if you're a 90% loan today, you could be paying sort of anywhere, it depends deal by deal, and there is some negotiation there, but it could be anywhere between maybe sort of 3.3, 3.4, all the way through to about 3.9. You're going to be paying at least 0.5% more than people with 20% deposit, but probably more than that. It could be anywhere between sort of 0.5% and 1% more, especially if there's low equity fees and low equity margins involved. As far as cashbacks are concerned, if you're over 80%, it's pretty hard to get cashbacks now, but there are some, and you know, the guys might get you $1,500 or something like that. But you know, with a 20% deposit, you might get $4,000 or $5,000. So, you know, there's an extra $2 or $3,000 worth of cash there that you can get from the bank. So when you're on a decent sized mortgage, when you add that all up, you know, you could be saving yourself, you know, $5,000 or $6,000 in the first year, and sort of, you know, $2,000 to $3,000 every year thereafter. So when you go to your parents and say, hey, would you mind being a limited guarantor and coming in honest with us? It's not to help us buy the house. It's because you're probably going to help us save $15,000 in hard costs over the next sort of 3 years. And when parents hear that, it's like, shit, you know, all I have to do is do this thing for you guys, and it's going to save you $15,000. That sounds like a pretty good equation to me. So, yeah, parental guarantees, really for you guys, it's about lowering your borrowing costs and saving you a decent wedge of money. It can help with the approvals as well, but I suspect these days, most of you guys can get to the 10% deposit. Can banks help with legal fees, moving costs? Yeah, they do. But they will give you a cash contribution. They're not typically that big where you're a low deposit borrower. We might get you $1,500. Look, in some instances, we might not get you anything if it was a really hard deal to get over the line. But generally speaking, there's some cash there. It'll cover some costs. It won't cover all of it. So Anara asked if you're a bit older, will they reduce the term? And the answer is probably not. If you're a first home buyer at 40, they view 70 as kind of the age that they want you debt free. So at 40, they'll still put it on a 30-year term. If we're getting up to 45, 50, they'll start to shorten the term then. But, you know, I had a first home buyer approved the other day, and I think they were 54, and the bank let me put on a 20-year term. So, you know, there's a bit of flexibility there. If my partner and I have worked for a council, regional tourism organisation, does this matter? Yeah, look, you've got a 20% deposit. I think in your situation, where you are working for an organisation that's potentially quite heavily impacted by recession, it is going to factor into what banks will do. Look, All it really means for us is that we've got to document your loan application a lot more. We're going to put a lot more effort into giving the lender comfort around your income situation. And provided we can do a good job of that, then we should be able to mitigate these things. I wouldn't say no to it, but we have to mitigate your unemployment risk. You guys know in your heart whether or not your job's at risk. What I would suggest is if you do feel that you are at risk of losing your job, then you really shouldn't be in the housing market. I think the worst thing, as much as I said, look, I think buying now is fine, and I think you're buying long-term, house prices will go up. Yes, house prices will fall a bit. They're already falling. If you buy well at the moment, you'll pick up that price reduction. Once I've said all of that, the caveat on that I would suggest is that I certainly wouldn't want you buying and selling or needing to sell in this market, because if you're needing to sell in this market, you're suddenly on the other side of this equation, and that's not a good place to be. So it's important to stay married, stay in your relationships, because man, that can be messy and expensive. And employment is just really critical. How do banks view applicants where one income is from a salary and one's from an ACC beneficiary? ACC is fine. ACC income is completely acceptable. So, so are benefit incomes. I mean, we include working for families. We include benefits in our servicing calculations, and we're allowed to. So no issues there. What is the benefit of a I know you'll have bias, which I will. What's the benefit of a mortgage broker over a bank or vice versa? Well, I think the thing that you get with a mortgage broker is that that's all they do. Day in, day out, they're helping people like you guys buy property. And hopefully what you've experienced tonight is just the level of knowledge that mortgage advisors have, not only in terms of the mortgage itself, but the whole house buying process. And they can really handhold you through the whole thing. I think the challenge with a bank is you can go into a bank and you can give someone your paperwork and they'll approve the loan, and the computer will say yes, and so they'll give you a piece of paper that says yes, and you go wandering off, and that's it. And mobile mortgage managers are a lot more friendly than that, and they can add more value. But banks are very reluctant to give advice because it creates risk for them. They much prefer just to give you a number and tell you to go out and look. Whereas I think with a mortgage broker, what you're going to get is a lot more hand holding through that process. Real I guess, empathy through the house buying process, as well as looking at, the properties that you're buying. We spend a lot of time sort of looking at properties, reviewing properties, providing feedback, and just managing heaps of stuff, especially with lawyers. Look, and invariably there's something that's never quite right. One of the big things for first-home buyers will be you'll be buying properties where there'll be a defective title, there'll be a cross lease and something won't be quite right, or there'll be something on the LIM report, or the sale and purchase agreement might have some warranties that have been taken out, buy it as is, where is, or maybe they never had some of the things we see all the time, like the ensuite was never consented, or they converted the garage into a bedroom. And there's something like about 30% of all property in Auckland has some sort of issue, code of compliance issue. So this stuff creeps up all the way through the process, and it's just nice to have people that know how to handle that stuff. I think that's what mortgage advisors do. As far as rates are concerned, much of a muchness, but you've got someone else negotiating for you. A loan structure is a loan structure, but it's nice to have a really good understanding of what your goals are, where you're going, and actually think further ahead than just like what you want to do next week. And I think there's some value there as well. So I don't know. Look, hopefully this whole session has kind of indicated the difference, but that's kind of how I see it. Good credit, bad credit. Yeah, good question. You guys are entitled to see your credit record. I would give it to you, but every time I run one, it costs me about $8, so it gets expensive fast. But you can write to your credit bureau, and they will give you a copy of your credit record within 3 days. Probably the most comprehensive and widely used credit record is Equifax. And if you go to their website, you can request a copy of your credit record. They post it to you, I think, still. They do that because I don't want too many of you doing it. But the other option, as pointed out in the Q&A, is Credit Simple, which is a free service. You can register for online and see your credit record. It's not as widely used bureau, so it doesn't have as much information on it, but it's got enough for you to get a sense for what your credit record looks like. And you'll be surprised. Look, the number of people that we see that have issues with their credit record that they were completely unaware of. The most common thing I see is old student stuff. The student overdraft that you never paid back. One of my advisors had that problem only a few months ago. And the other one is just bills from when you were flatting, an old telecom bill or an old, electricity bill that you forgot to pay when your flat broke up and you didn't realize that it's sitting on your credit record. So I think it, if you can, it's well worth just having a squizzy at your credit record, make sure there's nothing there. Are there pros, cons getting a cross lease with a friend and living in the dwelling? I'm not sure what you're asking there, Cassell, but I'm thinking that might be, is it worth buying with a friend? And we see a lot of that. There's nothing wrong with it. I think the main thing is if you're buying with a friend, that you have an agreement in terms of what the exit looks like, so that either of you can buy the other out, or you both agree that you need to sell the property. So I just think you have a property agreement that you draft up front that sets out, how you will handle the property, just in case something goes wrong later. And we've seen that, because people's situations change, people get partners, relationships change. Some want to sell to get their money out to buy something else. The other one wants to stay there. So I think if you just get clear up front, get it documented, that would be my advice. Now that the KiwiSaver market has recovered, would you recommend contributing the maximum amount to KiwiSaver? I can't advise on KiwiSaver because that's a financial advice product. But what I would say is there's no harm in contributing lots to KiwiSaver. It's very easy because it just comes straight out of your salary and you forget about it. But just be mindful of the fact that you're going to be pulling the cash out reasonably short term. So, like going into a growth fund, if you're going to pull your money out inside the next year, is higher risk because there's always a risk that you could have another significant drop, and you all saw how far it dropped and how quickly it dropped last time, and you could lose a lot of your deposit. So, I would tend to put my money into conservative. You're going to earn more in KiwiSaver than you earn leaving it in the bank, so it's not a bad place to put it. Priya, what if one partner's company has applied for wage subsidy and received full salary, and the other partner's company has not applied for wage subsidy and received full salary? You'll be fine. Like, don't overread the wage subsidy thing. It's just, think of it as, the banks are just concerned about employment risk, given that unemployment in New Zealand is forecast to go to about 11 or 12%. So they're just concerned about it, and they're just going to look at everything that they can look at to make a judgment call. If we can support you guys with good paperwork, and we can justify that there's no risk there, it should be fine. Can my sister act as a guarantor? Yes, absolutely. Anyone in your family, provided they've got the income to support the guarantee. One of the things that the banks, so if your parents are retired and living on the pension, we can't use them as guarantors, even if they've got a huge amount of equity in their property. That's really problematic because banks are concerned about putting the guarantors into hardship. So provided they've got the income and the equity in their property, then you can use anyone that we can justify has a personal relationship with you and has a vested interest in helping you out. The risks of a limited guarantee. on the parents is in the event that you default on your loan, so the bank can chase them for the amount that they've guaranteed, not your whole loan. So the 80% that you borrowed through the bank is yours and yours alone, and that's the bank's risk. But the bank will first and foremost go and sell the property. If there was a shortfall, so the property sold and there was a shortfall in terms of repaying the bank back, then they're going to chase the guarantor for the 10% that they've guaranteed. That's your risk. One of the things that we see with parental guarantors is, well, what if they're going to sell the property? You can move parental guarantees from one property to another. You can even substitute it for cash. So it doesn't need to be property as security. We've done an increasing number of limited guarantees that are actually secured over a term deposit. So your parents could have a 100K term deposit with the bank. They're earning the interest on it, and then we just use the term deposit as security. And to be honest, if you've got parents that are in that situation, they seem to prefer that than to put in the mortgage on their property. So that's another option. I'm nearly through all these questions, so bear with me. I'll try and knock them off in a couple of minutes. Should you try and get rid of your credit cards, extra vehicles? Yeah, look, I think I'd definitely just be conscious of your debt levels. We're still getting approvals with people with consumer finance debt. On its own, the way I want you to think about this is it's not one thing. It's a collection of things that the bank's looking at. So it's really the sum total of what you look like in terms of your financial responsibility. So, the reality is we're getting approvals through for people with a reasonable amount of consumer finance debt. I've got one in at the moment for a very high income first home buyer who's an immigrant, and they've got about 30,000, maybe 40,000 of consumer finance debt. And I think we'll still get it approved. It does impact on servicing, but they've got such strong income that they can afford the consumer finance debt and they can still borrow what they need. So affordability is not an issue even with consumer finance debt. The consumer finance debt was used to purchase cars because, of course, they've immigrated to New Zealand. It's explainable. It's not like errant behaviour. Good account conduct, good job, secure job, and genuine savings. So we'll get that through. So yeah, look, I just think it's the sum total. I think if servicing's tight for you, if you want to borrow, and okay, well, how do I know if servicing's tight? If you want to borrow more than 4.5 times your annual gross income, then you need to start to think about these things more seriously. So I think it's easy to borrow up to 4. So how does this work? Okay, let's make it easy. Let's assume that you have 100,000 annual gross income, right? That kind of says sort of 450,000, easy to borrow. As soon as you start to go over 4.5 times your income, it's going to start to get harder, right? So that's when you need to start to worry about some of these other things. I would have said 5 times your income historically. Certainly it would be 5 to 5.5 times your income if you've got a 20% deposit, but if you've got a 10% deposit, I kind of think anything over 4.5 times your income, and we're starting to have to look quite closely at consumer finance debt and stuff because it will be impacting on your servicing. Do all banks ask for registered valuations? Yes. Only where you've got less than 20% deposit. So if you've got a 20% deposit, more often than not, we will not require a registered valuation. Sometimes we do, but more often than not, we don't. If you're buying privately, not through a licensed agent, and therefore not buying in the market, we will probably require a registered valuation. And if you've got less than 20% deposit, then pretty much
almost always now. There has been some discretion in the past, but I think with the market the way it is at the moment, you should pretty much expect to need a registered valuation. Now, here is another benefit of the parental guarantee, right? Because as I said to you guys earlier, it's treated like a 20% deposit. So what that means is no registered valuations. So, you know, if you were trying to buy at auction, you know, which is always hard for a first home buyer, and try and avoid them if you can, but sometimes it's unavoidable. But, you know, if you buy an auction, it's incredibly frustrating to have to spend all this money when you don't even know if you're going to get the property, right? So the 20% deposit thing sort of helps there as well. It means that you can go to auctions, you can be a more confident buyer. You don't need to have registered valuations done. So hopefully that answers that for you. Look, I think I've covered off all of your questions, and there was a heap of them there, and they were all really good questions. I'm conscious that we've taken an hour and a half of your time, and mine. My wife's probably going to kill me. But look, hopefully that was really useful. If you haven't got a copy of our First Home Buyer's Guide already, highly recommend downloading it. It's just an awesome resource. And look, I guess we look forward to helping you guys in the future. Hopefully, when you're ready to buy a property, it is really busy out there at the moment. I mean, I think I said at the start, mortgage application volumes are up about 300%, and the banks are very difficult to deal with. They're taking a lot longer. They're a lot slower. They're asking a lot more questions. We're having to provide a lot more paperwork. So what I would say is, if you are going into the application process, just be a bit patient at the moment. Certainly, you know, it's going to be very hard if you kind of just rush in saying, I've just seen the house of my dreams. There's going to put a lot of pressure on the process. So please don't wait until it's urgent. When you are ready, get engaged, and just accept it's going to take a bit of time. Some of these approvals are taking 2 to 3 weeks to turn around, particularly where we're getting asked a lot of questions, and the advisors are very, very busy. So, and that's partly why we wanted to do these webinars, is just to give you guys as much information as we can, because we just know how slow and how busy and everything that the process is at the moment. So hopefully it's been really useful, and look forward to helping you guys later on. Thanks for coming. Talk to you later.